Mr. Chairman, thank you. Secretary Geithner, it's too infrequent that we have the opportunity to hear from you and to have a dialogue, and I'm going to ask questions, or at least ask you to respond to some thoughts that I have somewhat unrelated to the topic of today's hearing. But most of the banks in my state did not contribute to the financial crisis that our country faces today. They did things right. We still have bankers who say, no, I'm sorry, I can't make this loan, you can't afford to repay it. And yet my banks, which ultimately affect my constituents, are facing an increasing and uncertain regulatory environment. Examinations are becoming perhaps more frequent, but the uncertainty of the exam is clearly there. The FDIC insurance premiums have increased, and we now hear of a new Consumer Financial Product Safety Commission with potential additional regulations upon banks. And again, I want to stress that the banks that we have at home are not the financial institutions that we have been engaged in regard to Wall Street. The consequence of this uncertainty is direct upon the economy. I've had this conversation with officials at the Fed, and while the Federal Reserve has lowered interest rates in hopes of encouraging consumers to borrow money and to consume, the regulatory environment, particularly with the examinations, has discouraged banks from making loans. So we're at cross purposes, it seems to me, as we try to improve the economy. That uncertainty lends itself to borrowers that I visit with who say, we are current, where a company is making a profit, and yet our banks can't tell us whether they're going to reauthorize, renew our loans. In addition to that, it means potentially higher interest rates, which will reduce the demand, therefore potentially stifle the economy. And ultimately, the increasing cost of being in the banking business means that we will see increased consolidation, and yet one of the theories, at least that I think we've operated under, is that we want to avoid institutions that are too big to fail, and yet many of the things, it seems to me, that are happening at the Department of Treasury and within our financial system is increasing the role for consolidation. Increased cost of being in business means that we're going to spread the cost as best we can among a larger group of banks, and so we see continual consolidation in the industry. My point is that while it's damaging to my bankers, it's ultimately damaging to their borrowers, which is ultimately damaging to the United States economy, and I would appreciate any response that you might tell me that would give me comfort that that's recognized in the councils that you're engaged in.
Absolutely recognized, and it's a significant issue of concern. But, you know, what's causing those pressures on both borrowers and banks is the fact that the large parts of the financial system in this country just took on too much risk during the boom. And the cost of that, it's fundamentally unfair, but that's what happens in financial crises, fall not just on those who took too much risk, but they fall on a bunch of businesses and banks across the country which were very responsible and prudent. And that's why these things can be so damaging, and that's why it's very important that we do everything we can to put a better foundation for recovery in demand and growth, and try to make sure that the financial system has capital where it's necessary, and that these markets for credit start to get moving again. And that's the basic philosophy that's underpinned everything we've done. You're also right that there's a risk in financial crises that people overcorrect, that after a period of taking on too much risk, that they take too little. People that got way overextended pull back too much, and that can cause also a lot of collateral damage. And again, that's the basic rationale in a financial crisis for trying to make sure you do as much as you can to provide enough support for the economy to get back on track. But I'm very much aware of the concerns you expressed. I believe that the principal bank supervisors are too. They're carefully managing those risks. And you're also right that any time you think about reform to legislation in the financial area, that's going to come with a period of uncertainty. We need to minimize that uncertainty, and I think that's one reason why we want to bring clarity relatively quickly to the rules of the game that govern our financial system going forward. If we were to wait years to do this, the markets would be left with a greater period of uncertainty, and that might deter more lending and risk-taking.
I simply would ask that you continue to differentiate, or begin to differentiate, in my opinion, the difference between the significant financial players and those that are out there in the business every day of making loans for consumers to buy an automobile, to purchase a home, to plant a crop. It does seem to me that differentiation between those kind of banking institutions and the financial institutions ought to be treated differently, and I would hope that that be the case.
Mr. Chairman, can I respond very, very briefly? I would say I completely agree. And the approach we've taken is to apply more exacting standards to the largest institutions than we are to the 9,000 banks across the country that are in a somewhat different set of circumstances. And we are very committed to make sure that we preserve that basic balance. A great strength of our financial system is that we are not a nation of 3 banks or 4 banks or 5 banks or 10 banks, which is true across many, many industrial economies. We're a nation of 8,000, 9,000 very diverse financial institutions, and that is a source of resilience and strength. We want to preserve that.
Thank you for your answer. Thank you for listening to my point. Thank you, Mr. Chairman.